close till I get up. Time is barely on our side. I don't wanna waste what's left. The storms we chase are leading us, and love is all we'll ever trust. Yeah, no, I don't wanna waste what's left. And on we'll go, through the wastelands, through the highways, till my shadow turns to sun rays. And on we'll go, through the wastelands, through the highways, and on we'll go.
Good afternoon, class. So today we'll be going through the new topics, the life insurance business. So I hope all of you have studied before coming to my class, because I want all of you to explain to me what do you understand about this subject. So, anyone?
Me, sir. I want to share what I know about this topic.
Okay, you can start.
I know that insurance business classified into two main categories, like life insurance and general insurance. But when it comes to taxation, there are 5 categories that should be looked into. That is life insurance, life reinsurance, general insurance, inward reinsurance, and offshore insurance. I also know that insurance incomes come from insurance activities and shareholders fund. The most interesting part is that in insurance business, they treat investment income such as rental, interest, and dividend derived from investment funded by the fund account treated as a business source under Section 4A.
Wow, that's really good, Ismail. What about resident company?
Also, from a resident company perspective, I know that if the company carries on life insurance business and general insurance business at the same time, they should be treated as a separate business. In the life insurance business, investment income and profit from realization of investment of the life fund are taxed at the rate of 8%, whilst income of the shareholders fund is taxed at the normal corporate rate. The portion of the investment income and profit from realization of investment in the life fund is transferred to the shareholders fund as an actuarial surplus that is then taxed at the normal corporate rate in the shareholders fund. On the other hand, resident reinsurance business adjusted income is arrived in the same manner as that of a resident general insurance insurer.
Oh, thanks for the sharing, Ismail. That's really good. What about you, Adam? What do you know about life insurance business?
Well, for a non-resident life insurance company, whether the business is wholly or partly in Malaysia, the computation of taxable income is governed by Section 60, subsection 4 of the Income Tax Act. The provision recognizes the structure of life insurance companies, where funds are separate into the life funds and the shareholders fund, which will require the income to be computed separate for each fund.
So how do you determine the adjusted income?
To determine the adjusted income, the computation will begin with gross income. For the life fund, gross income includes income from investment made using the life fund, such as interest and dividends, whether the investment are made in Malaysia or elsewhere. In addition, the gross proceeds from the sale of investment are also treated as income. The law requires that the full proceeds from the disposal of investment will be included, even if proceeds will normally not be regarded as income in nature.
Okay, but what do we do with the shareholders fund?
For the shareholders fund, gross income consists of income from investment funded by shareholders' capital. Any actuarial surplus transferred from the life fund to the shareholders fund is treated as income of the shareholders' fund, and therefore it is taxable. From gross income, only specific allowable expense may be deducted. This includes the cost of acquiring investment and the cost of realizing or disposing of investment. However, no deductions are allowed for management expense or commission paid, regardless of whether they relate to the life fund or the shareholders' fund. When there is an actual actuarial deficit in the life fund that is transferred from the shareholders' fund, the amount is treated as allowable deduction in the shareholders' fund.
So what to do after the deduction of allowable expense?
After deducting the allowable expense, the result is the adjusted income. The capital allowance may be deducted only against the adjusted income of the life fund. The shareholders is not entitled to claim any capital allowance. And finally, after deducting the capital allowance, the remaining amount represents the statutory or chargeable income for each fund, which is then subject to Malaysian income tax.
Thank you very much, Adab. Also, thank you for your sharing.
Sorry for the late, sir. I got issue from home.
Oh, Mikael. So, what is your excuse?
Actually nothing. I just sleep for the class.
Okay, but before you have a seat, I have a quick quiz for you. How does the different annuities practice in a life insurance business?
Well, from my understanding, the deferred annuities refer to retirement products where individuals contribute funds now and receive income at a later stage, usually after retirement. However, in the past, life insurance company and family takaful operators combine annuity premiums with a life insurance fund, and the investment income earned was taxed at a rate of 8%. At the same time, individuals receiving annuity income were exempt from tax, similar to income received from approved retirement scheme such as the ETF. This situation meant that retirement-related income was still being taxed at the fund level, even though the purpose of the annuity was long-term saving. So, to address this issue, the government has introduced a change with effect from the year of assessment 2012 under paragraph 28 of Schedule 6 of the Income Tax Act, which is income earned by a deferred annuity scheme is exempt from tax provided the scheme comply with the retirement savings standard which approved by the Bank Negara Malaysia. And also the annuity funds are maintained separately from the life insurance fund. In the simple terms, this requirement ensure that retirement funds are clearly separated from the normal insurance funds so that tax exemption can be applied properly and monitored effectively. Subsequently, with the effect from the year of assessment 2015, the law was further refined to ensure fairness in the tax treatment. The amendment states that any adjusted loss arising from investment related to deferred annuities must be disregarded for a tax purpose. This is because the income from deferred annuities is already exempt from the tax and allowing the loss to be used to offset taxable income from the life insurance fund will result in the unfair tax advantage. Therefore, exempt income and related losses are treated consistently under the tax law.
That's really good. What about life insurance business?
Well, from my understanding, life insurance business refers to situation where an insurance company transfer part of its risk to another insurer in order to manage exposure and maintain financial stability. Although the life insurance business is related to life policies, it is treated differently for tax purpose because it's what to ensure accurate income reporting. Under Section 16, subsection 2, paragraph C of the Income Tax Act, life reinsurance business is treated as a separate source of income and is classified as general insurance business rather than life insurance business. This separation was strengthened with effect from the year of assessment 2019 following the Finance Act 2018. Under this amendment, Where an issuer carries of both reinsurance business and life reinsurance business, each business must be treated as a separate general insurance business. This requirement prevents insurer from mixing different types of risk and income in one tax computation, which helps maintain the transparency and correctness in the tax assessment. Once it's classified as general insurance business, the adjusted income for the life reinsurance must be computed under Section 16, Subsection 5. This involves considering premium received, claim incurred, and relevant reserve. The key point is that life reinsurance does not use the life fund method and must always be taxed using general insurance rules. And also, may I add some point is that what I understand from the both different annuities and the life reinsurance is that it illustrates the taxation of life insurance business, which designed not only to collect tax but also to support retirement saving and ensure fair income reporting. Understanding this provision is important because as accounting, they are frequently tested in the examination and also high relevant for in the professional practice, particularly in the tax compliance, audit, and advisory role. That's all.
That is really good. Okay, so you can take a seat. So last but not least, what do you guys know about the cost of acquiring and realizing investment under the life insurance business?
We don't know, sir. Can you explain to us?
So before the Finance Act 2015, Section 60 already allowed insurance company to deduct costs related to buying and selling investment. However, the law did not specify or clearly stated what type of expenses were included. So because of this, there was some type of confusion about whether investment management fees, like management salaries for the investment department, are deductible or not. So how do we solve this? Section 64C was introduced and become effective from the Finance Act 2015. This new subsection clearly stated that expenses incurred in the managing investment or right are allowed as tax deduction. However, these expenses cannot be deducted in full, only the proportion of it. So, is that clear?
Yes, sir.
Yes, sir.
So the video already finished and we have already discussed about the life insurance business under the section 60. Hope the subtopic of resident, non-resident, adjusted income, deferred annuities, life insurance, and the cost of acquiring and realizing investment are loud and clear. That's all from us. Thank you.